What is up, guys and girls, and welcome to DecDoesInvesting, the wealth, investing and finance channel. Before we start, I'd like to ask you to hit the subscribe button to join me on my journey, and also hit the like button to help me out with the YouTube algorithm. In today's video, I have episode 22 of my dividend investing journey, and since the last time I updated you guys, I have added another £1,000 capital to the portfolio and made 3 new investments. So I've been busy, to say the least. My first investment that I made was in Wetherspoons, in which I purchased 42 shares for an average price per share of £11.63, and I will go into the fundamentals and analysis in a minute. The next position I made was in Aviva, which is a stock I already owned, and purchased 98 shares for £2.52 each. And finally, I made another investment in Illegal in General, which again I already owned, and purchased 121 shares for £2.15 per share. So ignoring Wetherspoons for the time being, my reasons for starting to once again average down my positions is that I feel like Aviva and General have been trading sideways for a bit now, and I can't see another 30 to 40% fall happening again. It also does look like there is some sort of recovery on its way, with easing of lockdown in the UK markets, but for how long that continues we shall see. So I've had quite a few nice gainers this week in the portfolio, such as Legal and General, which rose 26.4%, HSBC, which rose 14.28%, Virgin Money, which rose 13.92%, and Aviva, which rose 13.52%. Now, I can't really find any specific major news as for the reasonings behind why these are my biggest gainers in terms of individually. However, I have found an article from the Evening Standard which headlines, "Stocks around the world jump after huge US job number and as Trump promises rocket ship recovery." The article reads, "The FTSE 100 index leapt after huge US job numbers sent investor sentiment sky high." The US added 2.5 million jobs in May, and Trump said the US was now on course for a rocket ship recovery. On Wall Street, the Dow Jones rose 3.67%, the S&P gained 2.88%, and the Nasdaq added 2.05%. So there we have it. Donald Trump once again sends the market into a craze, which was fantastic for my portfolio and has brought it back to almost break-even territory, which I didn't think would happen for a long time. However, analysing this article and the claims Trump thinks that we'll have a rocket ship recovery just seem too good to be true for me, in all honesty. I think the additional 2.5 million jobs is a great start. However, we must take into consideration of the jobs actually lost previously and the effect that they'll have in the long term. In my personal opinion, I do feel like we won't see the bad recession like we first predicted and expected. However, to have a rocket ship recovery while some stocks are already back at, if not above pre-pandemic prices, then that's bonkers and doesn't make sense to me. So moving on to my biggest fallers for the week, in which I want to cover Pfizer, which fell 5.71%. My findings on this is down to Pfizer halting a study on a potential breast cancer treatment. An article I found from MarketWatch headlines, "Pfizer stock plunges 7% after breast cancer study halted." It then goes on to say Pfizer shares fell 7% in after-hours trading Friday after the company reported that a study of a potential breast cancer treatment was halted because it was unlikely to achieve its goal. Pfizer said that a phase 3 study of, I'm not even going to attempt to butcher that, also known as Ibrance, was ongoing in 400 centres spread across 21 countries, would not reach its intended change in survival rates. This result is not what we hoped for, but we are steadfast in our commitment to advancing the science and care for people living with breast cancer, the chief executive said in the announcement. So my take on this article is that it's just the sort of news that is part and parcel of owning a pharmaceutical company, and clinical trials and developments are what push and decrease a company's share price. For me, this is one it's lost. However, in the future I expect Pfizer to win, should we say, and in the grand scheme of things, 5% isn't something disastrous, and I fully expect Pfizer to regain this loss over the next month or so. So that wraps up the news segment of this episode, and I will now go into the reasonings and analysis as to why I purchased Wetherspoons. Wetherspoons, which has the ticker symbol JDW and is traded on the London Stock Exchange, operates nearly 900 pubs, including the chain of Lloyd's No. 1 bars and a growing number of Wetherspoons hotels. Now, this has been a stock I've had on my watch list for a while now, and a company I have covered in a previous video, in which the playlist will be linked down below in the description. From a consumer standpoint, I'm a massive fan of Wetherspoons, and was a frequent user of their chains before the lockdown began. Not only does their price point make them really attractive to me, but the ease of ordering food and drinks from the comfort of your own table via their app is something I really like. Also, their app is something what sets them out from the rest, and one of the reasons as to why I thought now would be a great time to invest in Wetherspoons. As we know, the hospitality business is going to be one of the sectors that is going to struggle the most with conforming to the social distancing rules. However, what puts Wetherspoons at a major advantage is that they already have the infrastructure in their app to get the ball rolling straight away, without having to spend a vast amount of capital in developing an app or a website. Another attraction to Wetherspoons chain is the expansion into hotels, which in my opinion could be a really lucrative business model in the future. If we take a look at Wetherspoons on the 1 year chart, we can see that it was trading at £15.58 on the 5th of February before the market saw its crash, and had a 52-week high of £17.34. Like I said previously, I managed to pick up my shares for a price of £11.63 per share, which gave me a discount of around 23% off its 52-week high, which I'm very happy with. Taking a look at the shareholder returns, we can see that Wetherspoons over a 5-year period has returned 50%, which is 100 times greater than that of its industry average, which returned 0.5%, and over 3 times that of the market, which returned 15.4%. Despite Wetherspoons being established for a very long time now, I personally believe Wetherspoons still has plenty of growth left in them, and should see a nice rise in another 5 years to come. Simply Wall Street and its analysts currently undervalue Wetherspoons by 28% in comparison to its fair value of £15.53, which is a respectable discount for the UK's biggest pub chain. If we now look at Wetherspoons' forecasted annual earnings growth, it is a whopping 74.8%. We can see this beats its industry of 36.9% and over 3.5 times that of the market of 20.5%. This is also reflected in its forecasted annual revenue growth, which is expected to grow 12.3%, which is just under double that of its industry average and considerably greater than that of the market. These were the numbers that really attracted me to Wetherspoons, and back up my theory that Wetherspoons still has a lot of growth potential in the future. Looking at Wetherspoons' past growth analysis, we can see that over the past 5 years it grew 9.9%, which lagged both its industry and the market, which grew 10.3% and 13.2% respectively. This is also reflected in the 1 year earnings growth of Wetherspoons, which fell 3.5%. However, this was slightly better than its industry average, which saw its earnings fall by 10.9%, but lagged the market, which grew 2.8%. My take on these figures is that Wetherspoons is going to be a long buy and hold for me, and despite their earnings and revenue most likely being severely affected due to the pandemic, I still think over the long term, Wetherspoons is going to grow considerably. Now moving on to Wetherspoons' financial health, we can see that it doesn't cover its short-term liabilities of £381.6 million, nor its long-term liabilities of £1.5 billion. This was one of the things that marked Wetherspoons down in my analysis, along with its debt, as currently its pubs and hotels are closed and will be restricted once the lockdown is lifted. Therefore, their income is going to be seriously affected short term, which could be an issue for their liabilities that they owe. However, in my personal opinion, I don't think the pandemic will send Wetherspoons under, and this is a stock I'm happy to take a risk on. Now touching on to their debt, we can see that Wetherspoons has a ridiculous debt to equity ratio of 286.1%, and despite this falling over the past 5 years, another issue with this debt is that it's not covered well by its operating cash flow, which is going to be now further hit by the pandemic. Like I said previously, I don't think Wetherspoons will find themselves in financial trouble, and therefore I'm willing to take the risk on them with the potential future upside, as my portfolio is pretty conservative as it is. Now finally, Wetherspoons has suspended its dividend, which is understandable considering what we're finding ourselves in. But back in 2019 it did pay a dividend of 12p per share, giving it a yield of around 0.8%. Looking at the graph, it did maintain a dividend of 12p per share. However, this dividend didn't rise, and therefore I don't see this as a dividend growth stock, but more as one that I've brought for its capital appreciation, and if the dividend does get re-established, then it will be a bonus. So that wraps up my portfolio update for this week, and this week I have received 2 dividend payments, one from Legal & General in which I received £31.72 and Unilever in which I received £3.97, so in total I received £35.69, which is a fantastic amount of dividend to receive, especially when I haven't seen a payment for a while. So to give you guys an overview of the portfolio, it is currently sitting 0.62% down, or 0.42% down if we account for the dividend income and currency gain. So this has been a fantastic week for the portfolio, which is some huge gains from Virgin Money, Legal & General, Aviva and HSBC clawing back a big portion of our losses and leaving us at almost break-even point. As last week we were sitting at a 3.25 loss including currency gain and dividends. So fingers crossed this positive momentum can continue, and maybe it's a sign that the markets will be back on the rise. However, I'm still sceptical about this all happening. So thanks for watching. If you've liked the video, please drop it a like, subscribe if you want to see more content like this, and if you've missed any previous updates, there will be a link to the playlist in the description down below, along with some other videos. And until next time, peace.